Hey folks, we've almost done it. Survived 2020 and moving into 2021. I think it's so important to start recognizing our own personal investment strategies. I'm going to show you guys what I'm doing with it in my own brokerage accounts. We're going to go over a bunch of different sectors of the market, including some individual stocks that I think people should be paying attention to. And I found this really interesting scrolling around on YouTube, seeing what other big YouTubers are doing with their own investing strategies, at which I came across Joseph Hughes on Let's Talk Money. And he actually shares his own strategy, which I'm going to highlight toward the end of this video, but he pulls up some really interesting data points I want you to take a listen to.
This is another great chart here showing the PE ratios for each of the stock sectors plus the market index, that S&P 500. Now the dark blue line is the current price of stocks in each sector against the earnings that analysts expect over the next year. For comparison, that green bar then is the 10-year average PE ratio for each stock sector. So on the one side, you've got stocks of consumer discretionary companies, tech stocks, and industrials that are hugely expensive and really driving this market. On the other side though, you can still find some of those value in a few sectors like financials, energy, and healthcare that aren't trading quite as high off that 10-year average.
Now, unlike a lot of YouTubers, I think Joseph brings up a lot of awesome data points in this video, so I'm going to leave the link in the description below. I highly suggest you check it out. These data points here should really help Sherpa your focus to where you should be paying attention to in the market, which is where we're going to head in this video. So in the clarity of my transparency, do the channel a favor, hit that like button, folks, and let's jump right into this. Welcome back, passive income investors alike. Now, if you haven't figured it out, it's quite apparent that going into the end of this year, that tech stocks, a lot of the consumer discretionary stocks are insanely overvalued, and people think because they've had such a hyper past performance that somehow that's going to equate to some future returns, but that's just not the case. So what I would like to do is get into the different sectors of the market that I find most attractive, and a lot of my personal focus has been really geared toward REITs, financials, and it's pretty apparent why when you just take a look at the PE ratios against some of these high-flying companies. But now even Warren Buffett himself has been picking up a lot of these lower weighted companies, especially in the healthcare sector right now. When you're talking about things like Bristol Myers, you got Merck & Company, you got Pfizer. He has picked up all these companies in the last quarter, and it wouldn't surprise me if he continues adding more. But in my own personal circumstance, being a highly focused dividend investor, guys, I find the financial sector and the REIT sector so insanely attractive here, not only on the US, but on the Canadian side of the border as well. Some of my favorite banks right now are things like Canadian Imperial Bank, which is paying out a 5.3% dividend yield. It is recovered from its lows, but at a PE of 12.7, guys, it is still astronomically cheaper than most sectors. And even the healthcare sector of the market here, guys, I have been heavily loading on TD stock. I'm going to continue buying that. And on the US side, guys, we still got things like Goldman Sachs trading at a PE of 13. And, you know, Buffett's still loving his Bank of America here, which hasn't recovered at all from the crashes back in March. Now, more specifically talking about the REIT sector, which by far is one of my favorite sectors, and I'm going to explain to you why. Now, I want to share with you some analytics that Joseph Hughes actually pulled up in that video that we just referenced about the REIT sector, and it's some incredible data, so just take a quick listen.
Second here is that I'm using real estate as a hedge against any stock market weakness, but with a huge warning here. You cannot think of real estate as just one market. Now this table shows the year-to-date returns by property type, and the difference here is just stunning. While the overall real estate market, those REITs that trade like stocks, while that's down 12% on average this year, some sectors have been absolutely crushed, while others are actually posting a positive return. But a couple of these sectors are actually outperforming by a wider margin. Industrial property, so think things like warehouses and distribution centers, are up 9% this year. Self-storage is higher by almost 6%, and data center REITs are up a whopping 25% on the year.
Now, what he points out here that I think is so incredible, that you can even buy growth REITs right now that are still trading at really fair valuations when you're talking about things like Digital Realty. And on the Canadian side of the border, one of my favorite companies right now, Granite Real Estate Investment Trust, which is highly focused in logistics for things like Magna and even Amazon, guys, and I just cannot foresee this company doing bad anytime in the near term or the long term looking out, when more and more people are ordering online and logistics is just becoming such a big business. But the reason that I love the REIT sector so much, guys, is you can buy a diversified portfolio, giving you exposure to all these different sectors of the market, and you can even throw in insanely undervalued REITs, in my opinion, things like RioCan, which are starting to have a bit of a pullback today with the rest of the market. Now, I want to get into my individual brokerage accounts and show you guys what I'm doing with cash and a few of my other positions to start setting myself up here for 2021. But the first thing that I want to preface is that if you're an experienced investor, you have a fairly decent sized portfolio here, guys, there's nothing wrong with having cash. But if you're new to the market, I don't think this is necessarily the most appropriate time to be loading up on cash. The very specific reason that there's a likelihood that we're going to see more stimulus coming into the market. And what most people are unaware of is when the government starts doing stimulus, it brings down the value of the US dollar. And if this is something that you're new to, I'm showing you a chart right now, represents the US dollar index. And literally since March of this year, the US dollar has lost 10% of its value. And you got to remember that cash is like holding any other asset. It is very volatile in these tumultuous times. And being in Canada, just look at the comparison of the Canadian dollar to the US dollar since March. It is fairly staggering to see the volatility right now, and you have to be very cautious because if you are cash heavy, guys, you have to remember if we see a continued downside in the dollar, when you go to buy those stocks, you are going to be paying a premium either way. And if you look at the S&P 500 right now, which is trading up 10%, if you have been primarily sitting on cash, not only is the S&P up 10%, technically you've lost another 10% if you've just been holding cash instead of leaving it in the S&P. So technically against the US dollar, the S&P is actually up 20% year to date. Now getting into some of my individual brokerage accounts really quick, guys. Now I am trying to position myself into a more of a cash heavy position within means. I try not to get too much more than 10% in cash. But I will continue to cost average into the market even before we get into 2021. Now it's always nice to have a little bit just in case we see a wicked sell-off, but because there's so much value in financials, REITs, I'm still highly attracted to consumer staple companies like Kimberly-Clark, Unilever, and I'm just going to cross my fingers because at any major dip, I'm going to be loading up on those. And I've started pulling money out of the sectors of the market that just seem insanely overvalued right now, guys. When we're talking about the EV sector, I've been pulling money out of Tesla. As many of you know, I sold 4 shares out at about $594 a share. A lot of these high growth stocks have been running at an unsustainable rate, and the valuations have got so absurd. You can be as bullish as you want, but this just isn't part of the market that I think is going to be the most advantageous moving into 2021. Even in the tech market right now, guys, though I'm still very bullish on Facebook, it'll be likely the only tech stock that I don't start selling down in. I will never liquidate 100% of these positions, but I will start taking profit in things like Apple and Microsoft. I'm just doing it very cautiously because I still believe for as long as this pandemic is running wild, people are still going to be heavily flooding into tech because a lot of people are still going to be working from home. They're still going to need laptops for school. Like you could throw Amazon in there and people are still going to be ordering online. So I just want to be a little cautious on selling out of them too aggressively leading into the next earnings season. But as these cures begin to come online, we start seeing a bigger light at the end of the tunnel, guys. You're probably going to start seeing a shift from tech back into these lower weighted stocks that I can't believe are still trading at the values they're trading at. Now, this is my own personal strategy, but I just want to share one more clip from Joseph Hughes because I found his investing strategy is so similar to mine. So just take a quick listen.
Not just one more stimulus package, but maybe even another round. I'm bullish on stocks all the way through January. An emergency authorization for a vaccine is going to be a big sentiment boost, not only for investors, but just really for the real economy as well. I think you get a jump in retail store traffic, travel, and restaurant dining in those first couple of weeks afterwards. I'm more worried though as we head into the second quarter and then summer of next year, so maybe late February to May period. Even with more stimulus, it's likely that the longer-term economic weakness really starts weighing on earnings, and just the reality of how bad that unemployment picture is just starts showing through into the stock market. For this then, I'll let my stocks run probably through January, moving into some of those value names, but also keeping my growth stocks in tech. And then as we head into February, I'm going to be using a combination of 3 positions. One is I'll take some profits from this year's stocks and keep a chunk of it in cash, just waiting for those lower stock prices. I'll also rebalance out of some of those growth stocks for a bigger percentage in the value, especially in the 3 sectors that we talked about: energy, financials, and healthcare. Now finally, for the stocks that I do keep, I'm going to be selling covered calls against them, covered call options, to collect that cash and hedge against a further drop in prices.
Now I leave the question off to you guys. What is your investment strategy leading into the end of this year and going into the beginning of 2021? I absolutely love Joseph Hughes' videos. He's definitely one of the better, bigger YouTubers. I'm going to leave the links in the description below. I highly suggest you check them out. But in light of all of this, stay cool, stay awesome, and I look forward to catching you guys tomorrow.